Speaking of 2020, our next guest says stocks could see a big rally in the new year. Let's bring in Jonathan Golub, Chief U.S. Equity Strategist at Credit Suisse. Welcome back.
Thank you.
Just playing off this news from Elizabeth Warren. I mean, that's just one of the kinds of risks that investors are going to have to entertain in 2020.
And I think that you guys all got this right, which is this isn't going to happen. This is campaign rhetoric. This isn't really proposed legislation that has a shot. And there's all kinds of mechanisms to address these kind of things. And Karen, you hit it. This is not the way it's going to happen. But the more important thing is the market doesn't care. And frankly, I think right now, if you don't look at the polls, but you do a survey among Wall Streeters, what they're really saying is that you're either going to have the president with another term or a moderate Democrat, and that these issues are probably not issues that we're going to have to face. Whether that's right or not, I don't know, but that's really a consensus view among investors.
The headline for the market next year for investors is going to be what, do you think?
The headline is that the earnings are going to be okay. The market is going to do way better than you think on okay earnings. And I think,
how?
Well, I mean, look at the return of capital of the companies. Right now, you have a dividend yield of 2%. You have companies buying back more than 2% of shares, so the return of capital is over 4%. Interest rates are under 2%. You have a Fed who's been pretty clear that they're not going to be an adversary. I mean, look at last year. The Fed was adversarial to the market. This year, our estimate is that we'll probably end up with 5+% EPS growth. Last year, it was about 1, and not last year, 2019. So better, but not brilliant earnings.
Market can go up with that?
I think that's 100%.
Significantly?
My target is a little bit shy of 10% upside from here, and I think that you're going to get that. I think there's this weird reluctance people have when the multiple on the market is 18 to say it's already higher than normal, can't go any higher.
Well, only because most of the stuff that's happened in the market, the gains are due to multiple expansion now, right?
Yeah,
the earnings weren't there.
Really.
Now you really need earnings to carry it, don't you?
But take a look what happened this year is that the big pickup that we had in multiples was an unwinding of the fourth quarter of last year. So if you looked at this year and last year combined, you have basically, relatively flat-ish, multiples, and you have you're not looking at anything that's so brilliant. So, but I think the real key here is that the cost of capital is low compared to the return of capital. That means this thing is going to go up, and where people are going to get this wrong is they're going to only look at an earnings number, and they're going to miss the fact that the environment is supportive.
You can't make a market timing call on the back of this, but Warren Buffett's sitting around with $122 billion or so of cash. His big indicator, the one that he looks at, I think it's the Wilshire 5000 market cap over GDP is like 147%. Last time we saw something like that was, I think, in 2000. I mean, the market's extended on his metrics. Is that scary?
No. I mean, first of all, what that doesn't look at is what's the discount rate? What's the interest rate environment, and how strong is the economy? How much of look at Germany, for example. They have a huge economy and very small capital markets, right? We have a big capital markets and less bank lending. So it's is it a crude rule of thumb? Yeah, that's nothing more than that. So yeah, I don't see that there's right now is a headwind. What would make me concerned if you have if inflation, we have a tight labor market, nobody's talking about inflation. Do I think we're going to see it? Absolutely not. The market's a little bit ahead on the cyclical rally that we're convinced that the economic data is going to get better. Do I think it's going to show up? Absolutely. Could we be wrong collectively? Sure. I mean, right now, we still have an ISM that has not yet really shown any resilience to jump, but there's a whole bunch of other metrics that are saying it's going to. So I'm on the right side of this one. But, we could all be disappointed.
Jonathan, it's good to see you.
Good to see you.
Thanks for being here. Tim?
Well, it's interesting. And German factory orders this morning were down 0.4%. They're expected to be higher. So the German economy is not showing you any signs of turning around. The big numbers, we have payrolls tomorrow. So the question is, if the U.S. consumer stays working and stays employed and we get 3 to 4% wage gains, that's going to be very difficult to derail in terms of the economy. But what we're seeing and the trends, they're not terrible. But they're not good on ADP. They're not good on today's jobless claims. And, we're not hiring more people. We're not necessarily firing more people right now, but that's something you have to watch.
Here, quickly.
I mean, he makes sense. I think, actually, the Fed, I could see us getting more help from the Fed next year, actually, which would be good for stocks.